Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. This particular video is going to be one of my contributions based on my YouTube channel subscriber request series. And unfortunately I can't cover every video that is requested by subscribers, but occasionally I do come across one that I think tells a really great message. And I was recently asked to cover Align Technology. Now, I've never covered this stock. I've never researched this stock. I wanted that to be clear on the outset, but I can understand why I was asked to cover it. And I want to show you some things here. Especially, I want to point out some issues about valuation, specifically how you can avoid obvious mistakes if you pay attention to fair valuation. And this classic growth stock is a really good example. Now, I've got the performance report up here. I want you to notice this stock pays no dividends. Had you invested $10,000 in this stock on January 31st, 2001, your $10,000 would have grown to $148,814. That's averaging a 15.7% rate of return, which is significantly greater than putting $10,000 in the S&P 500 and including dividends having it only equal $25,000. But perhaps even more importantly, this has happened after this stock has had a significant drop in its price over the last few days. So let's take a look at its historical operating results. And let's start with, I'm going to start here with EBITDA, earnings before interest, taxes, depreciation, and amortization. And what I want you to notice, first of all, is that this is a very fast-growing company. Now, because I've got some distorted math here, I'm going to have to shorten this graph so that I get where I can start measuring a growth rate. And I can do that by going back to 2006. Now, by the way, performance since 2006, which is actually since December 30th, 2005, or the first day of 2006, would have turned 10,000 into 310,000. That's a 28.8% rate of return versus 10,000 growing to 27,000 in the S&P. So this company has really outperformed. And what I did here is I wanted to show you this was trading at a price to EBITDA of about 23.1, which is historically what this company's EBITDA growth has approximated. And I want you to notice how the price correlated to that. But this is the part I'd like you to focus on. This company got dramatically overvalued. Now, its growth rate has accelerated dramatically. If I shorten this to a much shorter time frame here, you can see that the growth rate actually accelerated over 25%. We had 18% minus 1%. If I take 2 more years off of this graph, it actually accelerated to 31%. So that's a 32% growth, a 43% growth, and then 34% for 2018. And this company has a December fiscal year, and then 24% expected for this fiscal year. Now, what I want you to see, though, is that the valuation of this stock, the price to EBITDA ratio, got up to a peak of over 65. And so this is what I call an obvious mistake, where the company got completely out of context or out of touch with its growth. Now, this is recent growth here. And so now, after the company is corrected, it's kind of reverted to the mean. It did that, from September through December of 2018. Then the stock rallied again, got overvalued, and has come back down into fair value. But let's look at a couple other metrics as well, just to put some more color onto this. So here I'm looking at adjusted operating earnings. You're going to see a very similar picture here. I'm going to shorten this time frame again down to that 2006 era, and we have very, very high operating earnings growth. So the orange line on this graph is representing a price to earnings ratio of 46.5, which is exactly equal to the company's earnings growth rate. We're using Peter Lynch's P equals growth rate formula here to value this terrific growth stock. And once again, we see how price tracked that earnings line. Now, if I put the normal PE here, the normal PE was slightly less at about 36. But the point is, this is a very high growth, therefore very high multiple company. But in spite of all that, we see that this stock got ridiculously overpriced coming into the fall of 2018, had a massive correction, rallied again, got massively overpriced, had another very strong correction, and now you're like the blue line, or the normal PE as a conservative valuation reference. It's getting close to being fairly valued there on a historical basis, and it's undervalued based on a historical basis using the P equals growth rate formula. But now let's go into forecasting here and look at the future. Now, looking at the consensus of leading analysts that are following this stock, there are 16 of them. They expect 21% growth going forward. So using the P equals growth rate formula here, this would indicate that this stock might still be overvalued, looking at it from a perspective of going forward. The longer term 3 to 5 year growth rate is expected to be 23%. Now, if you bought this stock here today, and this was was an actual reality. In other words, the company grew at 23.5%, and the PE ratio shrunk from 36, where it currently sits, to this PE growth rate 5 years out, you would still average 14% a year on your money. The question is, what would happen in between here? How much volatility would you have to go through before it got there? And that would be the same would be if I looked at the estimates here. If I went out for these are nearer term estimates, I'm only looking at a couple of years here, you'd average about 4% if it reverted to that mean PE. If it maintained its normal PE ratio, but I consider this unlikely because that normal PE ratio was predicated on the fact that the company grew so fast, and it's not expected to grow as fast going forward, but it still is expected to grow. But the moral of this story, what I'm really trying to get across here is that, valuation is tricky. There are a lot of ways to value a stock, and this is a pure growth stock with no dividends. And it's growing very, very fast. And it's a very interesting stock. Only has 4% debt, doesn't have a credit rating. It's a $16 billion market cap, has some cash on the balance sheet. That's why the enterprise value is less than the market cap. So it's very interesting, and it's starting to look interesting again as it comes back into closely into alignment with fair value. But again, the real question is, what's it going to do going forward? And that's where the forecasting graphs come into play. If it stays at a very high PE, it could be a good investment. But if it trades at a PE ratio that's related to its future growth expectations, and those expectations actually happen, then the price is still significantly overvalued. But the main message I want to get across here is, when you see valuations like this, in spite of how fast the company grew, this is an obvious mistake. Don't buy a stock when you see valuations this extended, because this is more than likely to happen. I think it's inevitably going to happen. Anyway, this has been Chuck Carnevale saying thanks for watching. Hope you enjoyed this subscriber request on Align Technology. I don't really know much about this company. FastGraph subscribers can go into the company's website or go into other research services and learn more about it. It might be one to start looking at now if you're a growth stock investor. It looks like a very interesting company, but it was significantly overvalued in 2018, and that was obvious if you were paying attention to valuation. If you liked what you see here, don't forget to hit our subscribe button and subscribe to our YouTube channel. Thanks again.